Hi, this is Tom Sedlak, General Manager at 33rd Company Property Management. Thanks so much for taking time out of your busy day to watch this video podcast. Today's topic is financing investment properties, and I'm sure you've been inundated with lots of offers and interest from third parties that want to help you finance an investment property, but it really boils down to a fairly limited number of choices and good choices that you can make in terms of financing your rentals. Residential brokerage, realtors, mortgage loan officers, other realty service providers all can provide some guidance and help when it comes to financing, but ultimately it's up to the individual investor to pick and choose from the best alternatives out there to maximize the benefit of financing, minimize the cost, and of course it all drives down to the bottom line for your return on investment at the end of the day. I think gone are the days of the zero money down investments or no money down, low doc, no doc purchases, the stated income loans. You know, all of that is pretty much gone by the wayside after the housing crash, and certainly with Dodd-Frank, the implementation of which drastically limited the amount of creativity certainly that banks were taking prior to that time to qualify investments and investment properties. Typically nowadays it does take about 25% down to finance an investment property. Usually the rates for investment properties are a little higher. The points might be a little higher with rate parity. And of course loan reserves are the other gotcha for rental properties. Is typically there's a 6-month or more requirement for loan reserves based on the rental amounts for any additional properties that you have already, and you need to have that on reserve before you can qualify for financing for an additional rental purchase. And also they will season, typically your mortgage officer or bank will season the existing leases, and if they're not in excess of a year, or if you haven't had the property as a rental for more than a year, they don't qualify for seasoning, and so those that rental income from those particular leases won't qualify. So what are your options as an investor? Well, certainly, you know, right off the bat, if you're just starting out in the investment world, you can certainly go out and get a conventional loan for a property 1 through 4 purchase, you know, your first 1, 2, 3, or 4th property that you're buying. You can typically find that most banks and credit unions will provide conventional financing for an investment property. And once again, they'll ask for 25% down, and the interest rate you're going to have to negotiate with that institution to determine whether it's competitive or not, and whether you need to keep shopping around. Once you get above 4 properties, it does become fairly difficult to get mortgages. There is a program called the Fannie Mae 5 through 9 loan, but it does require a lot of documentation. Typically, as I said, you're going to have loan reserves for each of the rental properties, typically 6 months of reserves. You're still going to have a 25% down requirement, and of course there's a lot of additional documentation you have to provide, and the interest rate typically can be a little bit higher. So that would be a question to ask your institution: is do you support Fannie Mae 5 through 9 loans? If you're buying a duplex or a fourplex, another option for you is to consider living there. If you're living in a duplex and you rent out the other side, you can qualify typically for a residential loan. Same thing with a fourplex. As long as you're not going greater than 4 units, where it would be considered a commercial multifamily, you'd be able to qualify for a residential loan at residential rates. Certainly the amount of the entire building is going to be subject to the minimum down, typically 20% for a residential loan, and your interest rates are going to be residential loan category expenses, and so they'll typically be a little bit less. But that is an option for you if you do have a desire to live in the rental property that you're planning on buying, especially a duplex or fourplex. Along those same lines, converting a residence is another very popular way to get yourself into rentals. In fact, you might even be living in the very home that's going to be your next rental property. And by buying a new home, moving into it, you qualify obviously for a residential loan. You're planning on living in it for greater than a year. And you're taking your old property and you're going to go back after you move out and fix it up, and then you put it up for rent. That's probably one of the best ways to convert a home into a rental or to get additional rental properties is to simply convert your existing residence into a rental and move on. And you can do that once every year. The stipulation for getting a new residential loan is that you're going to be living in that property for at least 1 year. And that's usually mentioned in the acceleration clause in the note of that loan, is that if you deviate from any of those requirements, that they could recall the note. They could recall your loan and make it immediately due and payable. That's called an acceleration clause. So anyway, that's probably one of the best. And another reason that converting a residence is a great path for you, not only is the interest rate and the financing easier to get for you when you're buying a new principal residence, but the reason you bought that home in the first place is because you liked it, because it had the number of bedrooms that you thought was convenient, it had the layout that you thought was convenient, it had the washing and dryer machines on the same level as the bedrooms, kitchen was open to the living room. All those factors that you used in buying a residence in the first place are the same factors that renters are going to use when they rent from you. And so we found that typically owners that have lived in a property that convert it to a residence, those are some of the better properties that are up for rent, and they rent faster, versus the investment properties that look good at the bottom of a spreadsheet but may not have all of those qualifying attributes that make it a really outstanding rental. And in fact, I'd even go one step further and say, even if you overpay for a home that has those functional high quality features that you would live in yourself, that are attractive to tenants, you're going to get that money back in spades by renting it, and you're going to have less problems with turnover, you're going to have longer tenancies, you're going to have less vacancy between tenancies. In short, your cash flow is going to be substantially better because you're going to have a much more attractive property in the market, and you'll be able to command higher rents. And so even if you pay $10,000 more, for example, over the course of a few years, you're going to get that money back in spades in a higher cash flow because it is a better rental property altogether. Another option for you in terms of financing is a contract for deed. A contract for deed is where the owner of an existing property has the deed in full, doesn't have a note on it, and turns around and contracts with you to purchase the home. And you basically stipulate the interest rate, the payment period, how long the loan is amortized for, the penalties for default, and all of those things. And then basically you're able to buy the property. The nice thing about a contract for deed is typically there's no qualification. There's no income qualification. There's no limits on how many other properties you own. It's simply an agreement between you and the seller in terms of what the structure of the deal is and what the agreed to payment schedule is. Contract for deeds typically have to be recorded with the county, but that's as far as that goes. And then once the contract has been satisfied, then the deed is completely turned over to the purchaser. One note is to make sure that the owner does have the title free and clear, because the owner may well have a loan on the property that also contains an acceleration clause or payment due when the title is changed, and that could cause some issues for you. Another option for you in terms of lenders is cash, obviously. You can do a construction loan for new construction. Sometimes those are organized by the builder through one of their preferred banks, and typically those can be negotiated and be pretty good, because their profit is typically from the sale of a property, and they don't want to overextend gaining from the loan itself. But nonetheless, that's an option for you, and construction loans can be pretty flexible, especially with their builder's bank. Hard money lenders. There are groups out there more and more now. Blackstone Group has a hard money group. They were originally buying properties during the housing crisis, and now they're actually allowing the financing of properties. Some of those are recourse loans, so be careful with that. A recourse loan means that they can have recourse against you personally versus the equity that's in the property, and so they could go after both directions, foreclose and go after you personally for an unpaid or for a default. The other problem is that sometimes they'll bundle. So it's not just the one property you're buying. They want to finance or have a lien against all of your rental properties for that additional property you're buying. So you're essentially ponying up all of your equity and all of your assets in order to get an additional loan on an additional property. So that's another little issue too. Bank portfolio loans, a lot of credit unions, smaller banks could provide a portfolio loan so that you are extricated from the requirements of the Fannie Mae and FHA programs for investment properties. That really boils down to having a good relationship with your bank and with the local lender. Sometimes, though, they will create loans out of their own portfolio, which means they have to have all of the cash on hand for the loan from their assets in order to write the loan. They're not underwriting it and selling it off to Fannie Mae or FHA, and so the bank has to have a long-term investment portfolio perspective if they want to do business with you for residential loans or residential investment property loans. The last one I'll talk about is a renovation mortgage. Again, Fannie Mae and FHA both have renovation or rehab mortgages. The Fannie Mae program is called the Homestyle Renovation Mortgage. Typically requires about 5% down, and what you can do is purchase a property, have a pre-planned amount of, say, $30,000 or $50,000 in additional rehab. So you're buying a fixer-upper, basically, and you're structuring both the mortgage and the rehab portion so that the home can be completed all together under one loan, and the construction portion is metered out based on the contractor and the completion of work after the home is purchased. And once it's all done, the theory is that the value of the entire property when it's fixed up is going to exceed the cost of the loan plus the construction portion of the loan, and then there's built-in equity that protects the bank. That's the renovation program. FHA, same thing. They have an FHA 203K rehab loan. Typically that loan requires 3.5% down, so it's a little more attractive in that regard, and has essentially the same elements of the program where you take out a base loan and a construction portion, and then you do the construction after the home is purchased. So those are your options there on a renovation mortgage. Putting it all together, it's clear that you need help from a full-service mortgage broker or bank. Certainly, you can seek out the services of experienced property management companies that do this day in and day out. A lot of times, the realtors that are out there, some are experienced with investments, and many are not. They just do residential home sales to prospective buyers and sellers that are planning on occupying or vacating, and not really dealing on the investment side. So it's really important to find someone that you can trust, that you know has the experience you need when it comes to investment properties. Thanks so much for listening to this video podcast. 33rd Company is an avid player in the investment market. We're well experienced, and if you would like to seek out our services, we'd be very happy to help you. Thanks so much.